Let's expand the conversation and bring you more on the markets. I'm joined by Warwick Lucas, who's portfolio manager at Vunani Private Clients. Warwick, a very good afternoon to you. Thank you so much for your time. I mean, as we follow and watch the ripple effect of the Middle East tensions, a tanker has been attacked trying to leave the Persian Gulf. And of course, traffic through the Strait of Hormuz remains constrained. Yet Brent crude oil is only around $88, $87 a barrel. What have markets made of the latest developments?
Rahul, good afternoon to you and the viewers. And I suppose we could say, well, are alternative suppliers actually cushioning the shock at all? And I guess partially, but you certainly couldn't say that the market's in any way relaxed. I mean, you know, the oil price is telling us that the physical supply shock hasn't become severe yet. I mean, oil is still moving. Alternative supply is helping, and global demand isn't so strong that every missing barrel immediately creates a crisis. But Hormuz is different from a normal supply problem. It's a choke point. It's, you know, like a naughty child bending a hose pipe and stopping it off. The risk is unpredictably messy. So most of the time the market could cope, and then suddenly one incident can change the whole pricing structure. So, yeah, Brent at these levels tell us that traders believe that the disruption is manageable, but it doesn't tell us that the risk has disappeared at all. So the oil price, it isn't in panic mode, that's off, but it certainly remains very skittish.
Yeah, like a naughty child bending a hose pipe. That really paints a vivid picture. Now, U.S. producer prices were unexpectedly flat in July, and consumer inflation remains relatively benign, helping the S&P 500 hit another record. How should one piece this together? Does it mean that the case for another U.S. rate increase has weakened? Where does it put us?
I think yes, the case for another US rate increases has weakened. I mean, flat producer prices suggest that some of the inflation pressure in the pipeline is weakening. And that's important because producer prices basically show what businesses are facing before those input costs get shoveled through to consumers and retail prices get fiddled with. So for markets, there was enough to ease anxiety about the Fed having to hike again. I mean, it also explains why equities, responded positively, and why the S&P just could keep going higher. But I must say, it doesn't mean that the inflation problem is solved. I mean, oil price is still a risk. Fed's going to be watching wages, services inflation, inflation expectations. So the pressure to hike is reduced, but the Fed is certainly not in a position to declare victory or rush into cuts yet.
Yeah, the U.S. economy continues to deliver strong corporate profits and record equity markets, while employment growth is increasingly weak, much like the outcome here at home in South Africa. What's your analysis? Can both economies boom without creating jobs?
It certainly can happen in the short term. I mean, it can boom in financial market terms, i.e. on Wall Street, but not necessarily for Main Street. In the case of the US, I mean, technology, AI, very profitable large companies can lift earnings and hence equity markets, even when employment growth is slowing, and businesses find a way to generate more revenue without adding workers as they have in the past. And part of that is the AI productivity story. So more output with fewer jobs, but there is limits. And certainly in the short term, there's pain. But one thing I can say is, from history, longer term productivity revolutions actually create more growth than they destroy in the longer term. In the case of South Africa, our version is a little bit more troubling because we're starting with a very, very high unemployment base. So weak job creation here isn't just a statistical issue. It's kind of life-threatening, and it's for individuals, and it affects social stability, tax revenue, and long-term growth. So we've got a different problem here.
And Warwick, very quickly before we let you go, Standard Bank's reported a record 26 billion rand first half profit, potentially putting it on track for 50 billion rand in annual earnings, even as unemployment reaches 33.6%. How are South African banks operating on this scale while the economy struggles?
I think it's one of the key features that we've been seeing in South Africa in the last 15 odd years. You know, strong companies sometimes operating inside a weak economy. You often get a champion that really sort of runs well ahead of the others. Now, I mean, Standard Bank isn't a simple reflection of an average household. I mean, it earns from corporate banking, trading income fees, lending, operations across Africa. It's got scale, technology, strong systems, and diverse revenue. So it can perform very well, even when unemployment is at a terrible level. But it doesn't mean that the broader economy is healthy. It just means that in a particular niche, a champion is doing well. But I think we need to see some proactivity in other areas to really change things around and get job opportunities on the table and moving.
Absolutely. Thank you so much for speaking to us this afternoon. Always a pleasure having you on the show. Warwick Lucas, Portfolio Manager at Vunani Private Clients, giving us a sense of what some of the leading market drivers are, as we, of course, continue to bring a reaction on the outcome of the unemployment data that was released this week.